Hi everybody, this is Gary Dean. This is our Sentiment Timing weekly video recap for Wednesday, September 30th, 2015. So the markets had a pretty nice bounce today. It was actually expected. We had some low sentiment readings yesterday, so it made sense. I don't personally think the lows are in. I still think we have another push lower, but the actual move today did kind of fit a profile. So I'm going to go over a lot of stuff tonight, so I'm going to just cut to the chase and get right to it so I'm not on here all day. Anyway, at Sentiment Timing, we believe that human beings and the markets are irrational, and there's always an irrational element at work, and that is what creates market opportunities. Now, we do this through Woody Dorsey's proprietary sentiment database as well as his technical timing indicators that predicts, when reversals are going to take place, and then we combine that with regular technical analysis. So, can the markets be predicted? I get a lot of emails like they can, and the reality is yes, they can, and you won't really hear any of that on TV because everyone that you hear on there looks out 3 to 5 years, but you really have no idea what's going to be playing out in 3 to 5 years. Woody's been studying the markets for 40 years, and these markets are much more predictable in the short term, and that's why we really only look out anywhere from it could be a couple weeks, it could be a couple months, but we keep it within that little time frame. We don't really care about the big picture because there's too many unknown variables that could pop up where you will have, if the Fed does QE4 and the market likes it, the market would go up. If they raise rates and the market doesn't like it, it's going to go down. There's things that you don't know, so why do you want to look out that far? So, there's a code that is, that Woody follows, and he's been doing this, and he's been studying these for over 40 years, and one of the things that he came up with was the kill zone, and that was on September 4th, and it was set to hit between the 14th and the 20th. This is supposed to be the 21st, and it started on the 19th. Then the beige hole was mentioned on the 3rd to hit on the 17th. It started on the 17th. And now we still have a pending black hole that's set for the fourth quarter. So these are all predictions that were 2 or 3 weeks before, and they played out pretty much as planned. So yes, the markets can be predicted. Now, I use a 3-step process. I'm co-owner of Sentiment Timing with Woody, and I use the service as well. Even though I do the writing for it, I still use it for my own trades, for trades I send out on Markets Path. And what I do is my process is a 3-step process, and it's time, sentiment, and technicals. So really it's when, where, and why is the best way to put this. So the time or the timing profiles that Woody gives, the projection dates that are, when the markets are supposed to reverse, those are the most important things that we look at. But we want to make sure that sentiment is supporting that, because almost all important reversals happen at sentiment extremes. Either people are going to be too bullish at the top and it's going to roll over, or too bearish at the lows, and they're going to rally. So making sure sentiment is in line is the next step, and then we want to look for where, and we do that through regular technical analysis. You do it through your Fibonacci retracement lines, support, resistance, moving averages, Elliott wave counts, and on and on. But that's where I try to look at where they're going to play out. So I'm going to give you some examples of how this, how it works, and then I'm going to bring it into what is going on right now, so I can give you some useful information. So on the 4th, we are looking for the high to hit on between the August 14th and the 21st. That is the, when is it supposed to happen? Why? Here you can see we had a series of very, very bullish sentiment readings right here. So here was the why. Everybody was bullish. Now, if we turn around and look at what was going on the technical end of it, we had in our report the resistance levels for 2103 to 2108 with an outsider of 2114. So those are really the areas that we were watching. We had bearish divergences in place, and it happened on August 18th. We saw the S&P drop over 240 points, and it was right in the between where our resistance levels. So this is the where. So that's, really how I use this, the system with it. So again, the when was August 14th to 21st. Sentiment was extreme bullish readings, and we had the where between 2103 and 2117 with bearish divergences, and again we saw a 240 point drop. So that is really kind of the system that I use. So if we go to 826, now we were, what he was saying was that we had sentiment, very bearish sentiments. We had, this is where you would normally see big bounces. So again, we didn't have the time period for the actual low. That did not fit. But we had sentiment that was at extremes. So again, it didn't mean that you wanted to buy, but what you wanted to do was cover your short positions. And from there, we had a double bottom, and we saw the S&P rally 160 points. Now, yes, it would have been a great long trade, but you would have been having to go through all this stuff. There was nothing easy about it. So the thing is, we had sentiment that was here. We had a pattern that was saying, okay, it was a low in place, but we don't have the timepiece. This was not set for the low. So it was not, buying was risky. So if we just carry on and bring this a little bit closer, on September 3rd, there should be a high on the 17th that should last between the 23rd and the 25th. Here again, you saw a series of high bullish sentiment. You saw intermediate sentiment get up near up the highs. So we had the when on the 17th. The Y was the bullish sentiment readings. And if we go now and just take a look at where we were looking at the moving average right here, we hit that exactly on the spot on the 17th. And from there, we saw the S&P drop 145 points, and we also had bearish divergences. So this was the where. So again, we had the when, September 17th. The why, did too much, everybody was bullish. And the where was 2117, which was the moving average. So that's really the process that I use with all of this, and it really has been working. So right now, again, we were looking for the downside momentum to end between 923 and 25. So we have very bearish sentiment readings, but if you remember, we took out those lows on Monday, and that was the 29th or Tuesday, I forget whatever one it was. But in any case, we had very, very low bullish readings, so everybody was bearish. So right now, we're in the time period when the markets should make a low. We're not there yet. There's two more that we're looking at. We have the Y. We're seeing bearish divergences, bearish sentiment. And now what you want to take a look at is where, and this is, this was your easy trade on the short side, and it was at support. We had bearish sentiment, and we also had bullish divergences. I covered my shorts. I got short here. I covered them here. Yes, I missed this piece of it, but it didn't matter to me because I made a lot of money on this, and I would have had to hold it through this 50-point rally even though it gave way. So moving forward, I don't believe these are the lows, or what may happen is we know when it's coming. It should be coming fairly soon. We're having sentiment extremes on the bearish side, but no panic. And what you'd want to watch is the 1866, 1820, or 1775. Now that is if we get down here. Remember, we're in the time zone when things could reverse up. We're seeing bearish sentiment, but we're not getting the panic, and we're not at that date. So if we take a look at the regular charts here, and you can see that the S&P rallied today up to the 1922. Here's your resistance zone. 1936 is another one. And we have bearish divergences. So I actually took a short position here because I think that at a bare minimum, we're going to get a push down here, and we could get that panic because we're right at another heavy resistance zone. Now, it's not guaranteed, and this short is not as safe as the one up here, but it was worth, in my eyes, a shot because we have the bearish divergences, and we don't have the actual date yet when a low is supposed to be made, but you have to be quick now. Like I said, the easy money was here. Right now, anything that goes on in the short trades, you have to be fast. Even if we take these lows out, the low is coming fairly soon, and we're going to get a very, very big short covering rally, and that's really what you want to, you want to be paying attention to the low end of it if you didn't get short, and that will probably come right at our dates there. So we've had the I had been showing you the beige hole and the black hole. Well, we got the beige hole that already came. We took out, we tested these lows. We now have a black hole that's pending in the fourth quarter. We don't have those dates. So if you're interested in following this system where you trade with confidence, it's very relaxed. You have a trading secret that only Woody Dorsey knows with these technical timing dates as well as sentiment, and over 40 years, that should be experience. We have 3 spots open for the $74.99. It moves up to the $99.99 after that. And I am continuing to give for MarketsPath the free membership for anybody that remains active on sentiment timing. I charge $80 a month for that, so it's a $960 value. If it should be automated, if it's not, just send me an email to gary.dean@marketspath.com. I give you morning notes, nightly video reports, my email trade alerts, and we also have a trading room. So until next week, let's see what plays out, and have a great night.